September 1929. A Manhattan businessman felt an unnamed pressure in his gut. Stocks had been rising for years, yet beneath the glow of prosperity, hairline fractures ran through the foundation. On a Tuesday morning, acting on instinct and mounting unease, he walked into his bank, handed over his passbook, and withdrew everything $12,000 in cash folded into his briefcase. By Thursday, just 2 days later, the market imploded with a force that would reverberate for generations. Banks across the country buckled as frightened depositors queued in front of locked doors. He, however, was insulated because he'd already taken possession of his money and could ride out the storm. Now, transpose that scenario to the present. You feel danger brewing in 2026 and try to replicate his move, pull your wealth, and get clear before the crowd catches on. You log into a 401k with $180,000 saved over 2 decades. You hit withdraw, and up pops a penalty calculator, federal tax, state tax, plus the 10% early distribution penalty for accessing funds before age 591-2. Your $180,000 shrinks to $98,000 before a dollar touches your hand. And it gets worse. The payout doesn't happen on the spot. It's queued, slated for processing in 7 to 10 business days under normal conditions. In a true panic, when many people request exits at once, these pipelines can seize up entirely. Not because your bank is insolvent, but because the modern architecture was engineered to stop exactly what that 1929 customer did get out. This is the quiet gap between 1929 and 2026 that almost no one talks about. It isn't only the prospect of another break. It's that when it hits, you won't be able to do what earlier generations did, grab money and bolt. Your savings sit inside systems with time locks, penalty gates, and legal tripwires that snap shut when the crowd rushes the exits. Every lock was crafted intentionally, not to protect you, but to protect the system from you making a rational, self-preserving choice when the storm forms. The 1929 disaster was fueled by speculation, leverage, and debt. The 2026 version becomes catastrophic for a different reason. Digital cages that prevent escape even for those who see it coming. Here's how we arrived at this point, why the restraints are tighter than ever, and why 2026 makes 1929 look like a warm-up. The 1929 collapse wrecked lives by the millions, but it still preserved one thing our era has quietly erased: immediate access to your own money. Grasping that difference is essential to understanding what's been lost. In 1929, a savings account was straightforward. You walked into a branch with a passbook, a small ledger of handwritten entries, and asked for your balance. A teller counted out physical cash. Same-day withdrawal of your full balance was ordinary. No processing windows, no layered approvals, no suspicious activity reviews. If it was yours, you had it within the hour. Stock ownership was similarly direct. Buy shares and you received paper stock, certificates, ornate documents listing your name and share count. They weren't just digits in a database. They were tangible property you held. To sell, you either found a buyer and handed over the certificate for payment, or used a broker with settlement in 3 days. Not 3 weeks and not subject to a maze of halts beyond known rules. 3 days, consistently. Investors who sensed trouble in September 1929 had options. They could sell positions, pull deposits, convert to cash, or gold. Many did. The failure wasn't that the system prevented exit. The failure was that most people didn't recognize the danger in time. When the break came on October 24th, 1929, those in cash or gold held on. Those who hesitated, believed reassurances, or waited just a little longer were crushed. But the destruction flowed from choices, not from a mechanism that forbade action. Banks that failed didn't preemptively freeze everyone's accounts. They didn't impose withdrawal caps or require supervisor sign-off for large cash requests. They collapsed because too many withdrawals drained them too fast. That's a bank failure, brutal, yes, but fundamentally different from what exists now. Even margin was blunt and visible. If you bought with 10% down and 90% borrowed, a drop triggered a margin call. If you couldn't meet it, the broker liquidated immediately to protect their loan. Drastic, instant, transparent. You always knew your position. Contrast that with today's retirement accounts. Boxed behind penalty walls until 591-2. Contrast that with banks that can pause activity for suspicion if you pull too much too quickly. Contrast that with funds that can legally suspend redemptions during turbulence. The 1929 generation faced a vicious market, but not a system purpose-built to trap them. We are living inside one. After 1929, regulators didn't only aim to avert a repeat, they built something more sweeping, a financial machine designed to keep people from fleeing mid-crash. Across the reforms from 1933 through 2010, a consistent objective emerges: limit the ability of ordinary savers to kick off runs and cascades by pulling their money. The first major lock was the 401k, introduced in 1978 and marketed as a tax break. Step back and look at what it became. Roughly $7 trillion American retirement assets held behind penalty walls. You contribute across a working lifetime, but can't tap it without eating combined taxes and penalties that commonly carve away 35 to 45% of what you withdraw. And penalties are only the first lock. Time is the second. When you request a 401k distribution, the funds don't manifest instantly. Plan administrators must process the request, typically 7 to 10 business days in normal conditions. Under stress, when withdrawal requests surge together, those timelines stretch. Some providers can legally suspend distributions outright for administrative review or uncertainty in valuing plan assets. In 2008, that happened. One of the biggest administrators, Fidelity, put certain withdrawals on hold for weeks. People logged in to see temporarily unavailable. Their balance appeared on the screen, but they couldn't touch it. Not because the money wasn't there, because the rails include gates that close during volatility. Banking has likewise tightened practical access to cash. Try to take out $10,000 or more in physical currency. Federal rules require a currency transaction report to FinCEN. Banks can also delay disbursement for a suspicious activity review if your request looks abnormal. Daily ATM caps, often $500, $1,000, mean that even with $50,000 in your checking account, extracting it as cash could take 50 to 100 separate withdrawals over weeks. The panic may pass long before you've retrieved your own funds. Then there are investment accounts, mutual funds, ETFs, brokerage holdings, where the ability to sell relies on market makers staying in the game. That liquidity tends to vanish exactly when you need it most. In March 2020, more than 200 exchange-traded funds traded 10 to 20% below the value of their underlying assets. Your $100,000 ETF was only sellable for $80,000, $90,000, not necessarily, because the portfolio had fallen that far, but because the market structure hiccuped. Mutual funds have explicitly codified traps. Under SEC Rule 22E4, funds can hold up to 15% in illiquid positions. When those limits get breached, a fund can suspend redemptions entirely. This isn't theoretical. The UK's Woodford Equity Income Fund froze redemptions in June 2019, trapping about $3.7 billion for more than 3 years. When distributions finally resumed, investors recovered roughly 70 cents on the dollar. Real estate investment trusts did much the same in 2008-2009, freezing withdrawals for an average of 18 months. Private equity funds standardized 7-year lockups with no early exit. Every one of these designs was presented as investor protection or stability enhancement. The effect is identical. Your money is no longer available on demand. It's available on the system's timetable, subject to conditions that tighten precisely during stress. The 1929 investor could take cash and leave. The 2026 investor will hit withdraw, watch a spinner, and discover the request is pending delayed or suspended if conditions worsen. By the time access arrives, the value you were trying to preserve may have been gnawed away. These mechanisms already exist in every retirement plan, every bank account, every fund or brokerage. They're dormant until everyone heads for the exits at once. The locks aren't new. What makes 2026 dangerous is what sits beneath them: unprecedented debt, algorithmic trading, and a Federal Reserve with less dry powder. Start with leverage. In 1929, you could buy stocks with 10% cash, 90% borrowed, 10-1 leverage that turns a 10% slide into a wipeout. Regulators later raised margin to 50%, believing they had solved it. But modern leverage hides elsewhere derivatives, collateralized loan obligations, private equity structures, creating 50.1 exposure off balance sheet. When that unwinds, it won't be measured in months like 1929. It will unwind in hours as machines execute pre-programmed sell rules. Unlike 1929's shouting on a trading floor, today some 70% of volume is algorithmic, firing off millions of orders per second. Those systems sell when volatility trips limits, when momentum breaks, when correlations scream stress. One wave of selling triggers another, setting off cascades that outrun human reaction time. We already saw a hint in March 2020. The S&P 500 fell 34% in 23 days, the fastest bear market on record. Circuit breakers halted trading multiple times to let cooler heads prevail. The halts didn't stop selling. They compressed it into shorter windows, making the next move even more violent when sessions resumed. Now, pair that with the traps already described. Your 401k drops 30% in 2 weeks. You submit a withdrawal, prepared to eat a 40% hit in taxes and penalties. The request sits in processing while markets peel off another 20%. Approval arrives after a 50% drawdown. Then you pay 40% on what remains. A $200,000 nest egg turns into $60,000. That assumes it's approved at all. In peak crisis, administrators can invoke extraordinary circumstances, clauses suspending distributions entirely. You watch the number shrink without recourse stuck in rails, designed to do exactly this under stress. The banking side isn't immune. In 1929, failures occurred because banks couldn't recall loans or liquid assets fast enough when depositors demanded cash. Today, banks sit on more reserves and face tighter rules. But reserves don't matter if the payment pipes seize. Modern finance runs on digital plumbing, Fedwire for large transfers, ACH for routine flows, SWIFT for cross-border. Each has throughput limits and can jam under strain. In September 2019, during expansion, not crisis, the overnight repo rate spiked from 2% to 10% in a single day. The Fed had to pump in $75 billion to unstick the gears. That was during calm. In real panic, those rails can stall. Silicon Valley Bank is a more recent concrete example. It went from trouble signs to failure in roughly 36 hours in March 2023. Clients learned Thursday afternoon. By Friday evening, regulators stepped in. Depositors above $250,000 didn't regain access until the FDIC set up a bridge bank the following Tuesday 4 days, without funds. For firms with payroll and vendors, 4 days was existential. Scale that up. Not a single regional bank, but many. Not billions in deposits, but trillions. The mechanics don't scale smoothly. The FDIC's insurance fund held around $125 billion against roughly $10.5 trillion of insured deposits. If only 5% of banks fail at once, the math becomes untenable, and policy tools are weaker than before. Rates stand near 5%, leaving less space to cut. The Fed's balance sheet is already swollen by rounds of quantitative easing. Federal debt sits near $35 trillion, constraining the capacity for massive stimulus. In 1929, people could at least attempt to save themselves, withdraw cash, buy gold. Today, the exits are largely shut by design digital gates, penalties, processing delays, and legal restrictions primed to clamp down when the crowd bolts. The Great Depression's index took 4 years to bottom, in part because people could withdraw and sit in cash. The 2026 spiral would likely be sharper and deeper precisely because people can't. If you look closely, early moves are already visible, not in headlines, but in what those with the most to lose are doing quietly. Corporate insiders, sovereign funds, institutions with data you'll never see. In Q4 2024, insider selling by U.S. executives reached levels last seen in 2021, about $16.2 billion in 3 months. Executives exercised options and sold at roughly 4 times typical rates. These aren't jittery retail accounts. They're CEOs, CFOs, and directors who see the quarter before it's public, who sit in meetings where real problems are discussed. Insiders don't reposition for a 10% dip. They de-risk before something bigger breaks. Sovereign wealth funds echoed the shift. Data from late 2024 showed reallocation out of U.S. equities toward gold, commodities, and short-duration bonds. Norway's government fund cut equity exposure by roughly 18% in 2024. Abu Dhabi's fund increased gold to levels last seen in 2008. These players don't spook easily. They run trillions over decades. When they tilt defensive, they're trading upside for stability because their risk models warrant it. Meanwhile, the U.S. Treasury market, the $27 trillion backbone of global finance, began flashing stress in October 2024. Liquidity thinned. Bid-ask spreads widened. Large orders that once nudged yields by a few basis points started swinging them by 15-20 basis points. That's the kind of illiquidity that precedes breakdowns too few market makers willing to stand in. When even treasuries get touchy, confidence is thinning at the core. And as these signals flicker, the familiar chorus keeps playing: strong economy, solid earnings, valuations justified by innovation. The same tune was played in 1929. This time is different. It never is. The Shiller P/E ratio stood near 39 in October 2025. It was around 32 before the 1929 crash and near 32 before the dot-com top. Today's level is about 23% above both. The story now is that artificial intelligence warrants multiples prior generations would have called unreasonable. The yield curve has been inverted since July 2022, now more than 3 years. Every recession in the last 70 years was preceded by an inversion, usually 12-18 months ahead. We're about 39 months into inversion, well past the usual lag. What makes this moment uniquely dangerous is that all these warnings are blinking while the trap architecture is fully live. In 1929, people had exits even if most didn't use them. Right now, those who recognize the risks insiders, sovereign funds, institutions, are quietly shifting. The typical saver with a 401k and a checking account is still being told to stay the course, keep contributing, and ignore noise. They're being positioned as exit liquidity, the last buyers before the trap shuts. History doesn't repeat exactly, but it rhymes in patterns anyone can see. The 1929 episode wasn't random chaos. It was the arithmetic of too much debt, too much speculation, and the belief that old limits no longer applied. The 2026 version follows the same script with one crucial twist. When it hits, you won't be able to do what the survivors of 1929 did. You won't walk into a branch and withdraw life savings by afternoon. You won't liquidate investments without penalties, delays, or outright suspension. You won't have the freedom to protect yourself because the system was constructed to curb mass exit. Remember the man in September 1929? He made it through because he acted before the herd accepted reality. He didn't need clearance. He didn't wait for processing. He didn't pay penalty tolls or hope the rails wouldn't freeze. He saw risk, took custody, and got out. That option is largely gone. The exits that saved him have been sealed, yet choices remain. Acknowledge the locks and operate within them. Reduce future contributions to penalty-bound accounts, redirecting to funds you can reach, even if it costs tax advantages. Build liquid reserves outside the retirement chassis, accepting today's tax bill rather than betting on access tomorrow. Watch what insiders do with their own money. When the people in charge are selling while telling you to buy, it warrants scrutiny. Or you can do what most will do, then trust the machinery, accept the reassuring lines, feed contributions into accounts you can't access in crisis, and assume that this time really is different, that algorithms and AI dissolve the business cycle, that central banks can prevent any real pain, that markets only rise if you wait long enough. Each generation dresses the same belief in new language. The 1920s thought industrial technology made prosperity permanent. The 1990s thought the internet rewrote the rules. The 2020s believe artificial intelligence has conquered risk. It's the same idea with different packaging. The people who endure crashes aren't necessarily the smartest or best connected. They are the ones who recognize the pattern early, who are willing to look cautious while others celebrate, who understand that defending capital matters more than chasing the last 20% of a stretched bull. The locks are in place. The indicators are the brightest they've been in decades. Insiders are edging toward the door while telling the public to stay put. The question isn't whether turbulence is coming. It's whether you'll be stuck trying to exit through doors that no longer open held behind digital gates while your balance shrinks, or whether you'll already be outside the cage before it snaps shut. Your grandfather's era could take cash and run. You can't not in the same way. But you can still prepare while there's time. Because once everyone tries to leave together, the gates close, the pipes freeze, and the wealth you thought you owned turns into a number on a screen that falls hour by hour while you watch, unable to act. The decision remains yours. The window is narrowing.